Do you want to learn how to read the market like a book every single day? Well, welcome to today's video. In today's video, what I'm going to teach you how to do is how to get your daily bias correct 99% of the time. I've been trading for over 3 years, so I have great experience in the market and I understand how the market moves. That's why I'm able to read it very easily. So that's what I'm going to teach you guys today. So get ready, pay attention, because this can genuinely change your life. Okay, perfect. So before I teach you how to read the market like a book, you firstly need to understand, where does the market want to go, right? There are certain confluences or certain areas that the price, well, the market tends to go to. So these are the three areas that price wants to seek. Firstly, we have liquidity. Second, we have imbalances. And thirdly, we have discounts, right? Once you understand that price wants to draw or price wants to go towards these levels, this is going to allow you to be able to read the market very, very easily. So let's get right into what these three things are and how to identify them. Okay, so right here we have the three phases that the market goes through. We can see we have uptrend, we have consolidation, and we have downtrend. So now these are pretty much the three ways that the market is going to move. Now, what I'm going to do is run you through how to identify liquidity. Now, as we can see in this uptrend, we are forming higher highs and higher lows, higher highs, higher lows, higher highs, higher lows, so on and so on. This is within an uptrend. Now, within an uptrend, where does liquidity rest? Well, what you need to understand is that liquidity rests below the lows. So this circle that I'm drawing out, that is where liquidity rests. So as we can see, we have liquidity below this low as well. We have liquidity below this low as well. Just like that, that is how to identify liquidity. Now, guess what? We also have liquidity resting above the highs, right? Price is when it's forming these higher highs, liquidity, liquidity, liquidity. Now, you may be asking, what is liquidity, Seb? What does liquidity even mean? Why does price have liquidity below these lows and above these highs? Well, quite simply, liquidity is this. Liquidity is resting orders, right? So the way you got to see it is, below the lows, there are orders waiting to be filled. See it like this: pools of money, literal pools of money that are waiting to be gathered in order for the market to continue in the original direction of the trend. Now, for example, when we see in the uptrend, we have liquidity resting above these highs. Well, where does price want to go to? Well, it wants to target this liquidity. It wants to target these pools of money, these resting orders, in order to gather that and then boost movement with that momentum. So yeah, as we can see, we're targeting this high, we're targeting this high, we're targeting this high, and that's why we keep forming these higher highs, higher highs, higher highs, and so on and so on and so on. And it's the exact same principle with consolidation and downtrend. So consolidation, which we also refer to as chop, as you can see, we pretty much have these equal highs and these equal lows. Now it's the exact same thing. Resting below these lows, we have resting orders. Resting below these lows, we have liquidity. Now, same thing. Resting above the highs, we have liquidity as well. Now, what does price want to do? It wants to gather liquidity and then make a continuation. So it's that simple. And it's the exact same thing with a downtrend. It's above the highs, above the lows. So that's what you need to remember. Price wants to draw, or price wants to go towards liquidity. Right, now on to the second part. Now, on the second part, we identified that price wants to go towards imbalances. Now, what is an imbalance? Another way to refer to an imbalance is a fair value gap. So what is a fair value gap, right? Well, we can see that we have bearish fair value gaps and we have bullish fair value gaps. Now, fair value gaps are formed in a 3 candlestick pattern. So remember this. As we can see in this case, this is a bearish fair value gap. So we have 3 candles going down: candle A, candle B, candle C. Now, the fair value gap, or the imbalance, is formed from the low of the wick of candle A to the top of the wick of candle C. Just like this. This is our bearish fair value gap right here. Now, this is what we call a bearish imbalance. And what does price want to do? Price wants to draw into that imbalance or target that imbalance in order for price to rebalance itself out, right? The market can't keep moving imbalanced. It has to be rebalanced. Do you see what I'm saying? So that is how to identify a bearish fair value gap. Now, with a bullish fair value gap, it's simply the other way around. It's a 3 candlestick pattern, A, B, and C. And it's the top of the wick of A and the bottom of the wick of C. So if I just mark it out like this, we can see that this is now our imbalance or our bullish fair value gap. Now, what does price want to do? Price simply wants to draw towards it or target it, rebalance the price or rebalance the market, and then get a reversal and a continuation in the direction of the trend, which in this case is bullish, right? Do you see what I'm saying? So that is what an imbalance is. Okay, now let's move over on to the third part. Now, the third place that market wants to draw to is towards a discount. Now, the way that I like to trade and the way that a lot of traders, like to trade nowadays is following the institutions or following the big banks. Why? Because these are the people or these are the individuals who are putting in millions and millions and millions into their orders. Now, do I want to follow the actions of a retail trader who's unprofitable, or do I want to follow the actions of the big banks, institutions, hedge funds who are putting in millions and millions and millions? Well, yes, I do. So how do they operate? Now, when they want to put their money into a trade, whether it's in the NADAQ or in the S&P, they want to get in at a discount, right? It's as simple as human nature, right? We can see in this case, we have an uptrend and we're just going higher and higher and higher and higher. Now, as an individual with millions and millions and millions, would you want to put in at this price here? No, you obviously don't, because you want a better price. You want a better value for your money. So here's how it works. With a discount, or as we can call it, equilibrium, what we do is we mark out from the bottom of the move, which is this 0 area, up to the top of the move, which is this 1 area. Now, the way that the banks and institutions want to work is they want price to come into this 0.5 region or into this bluish region for me, which is a discount. And then once we come into that discount, bang, they then feel comfortable to put their money in because they are getting a better price. Now, as we can see, price comes up, comes down, targets this discount, and then continues up to this external high. Now, that is exactly how the market moves. It's as simple as that. And if you don't believe me, just hold on a second. I'm going to show you tons of examples which demonstrate that this is literally true. This happens all of the time. And think about it. Why would they want to buy up here when they could buy down here? Now, if we pair that with our other confluences, imbalances, fair value gaps, liquidity, you're going to see how it all comes together. And this allows me and is going to allow you to read the market like a book every single day. Let's get right into it. All right, perfect. Now that we know the 3 places that the market wants to go to, let's look at some examples demonstrating that this is truly the case. Now, if we look here at the NASDAQ, we can see that we are clearly in an uptrend, right? We can see that we're forming higher highs and higher lows, higher highs, higher lows. Now, let's use our confluences to see how we could have read the market like a book from October the 30th to March of the following year. Now, let's simply mark out some key areas. We can see that right here, we have a low. Right here, we have a low. And right here, we have a high. And this is just like I was showing you. Now, where does liquidity rest on this uptrend? As we can see, we're forming higher highs and higher lows, higher highs and higher lows. Or liquidity simply rests below the lows. Now, we have a low here. We have a low here. We have a low here. We have a low here, and so on and so on and so on. Now, what does the market want to do? Well, quite simply, the market wants to come down, targeting all of these internal lows. Why does it want to target them? Simply because they're resting orders. They're pools of money. If the market wants to continue in the uptrend, it needs momentum. It needs that push, right? So that's why it comes down, gathers these resting orders, gathers these pools of money, and as you can see, we then get that reversal. Now, what else do we find? Well, we also notice, what was the second part? Imbalances. The market wants to fill imbalances in the market. Now, on this way up, we form lots of bullish fair value gaps. However, what have we formed right here? Now, let me zoom in so that it's super, super clear for you guys. If we look at the market right here, we can see that we have a bullish fair value gap. Right? We have a bullish fair value gap. Why? This is a 3 candlestick pattern. Candlestick A, candlestick B, candlestick C. The top of the wick of A, the bottom of the wick of C. This is an imbalance. Now we can see that this imbalance has already been retested and we have formed this low within the imbalance. However, what does the market want to do? Wants to come down, target all of the liquidity, sweep out this low, as in gather the resting orders right below that low, fill in this imbalance, and then as you can see, reverse and continue back up to the external high. So now that is part A. and part B. Now, what is part C? Well, yes, part C is a discount. The market wants to draw towards a discount. So if we mark out from the low of the move to the high of the move, this being the low, this being the high, we can literally see the market comes up, comes down into a discount. Why? Because the big banks and institutions are thinking, nah, I don't want to buy up here. Why would I put all my money in here if this is not a good price? I want to wait for price to come to a good area and then I want to invest. And as we can see, the market comes down, taps into this bluish zone, which is a discounted area or equilibrium. And then we get that strong candle and then we get that nice reversal straight back up to these external highs. Now, that is exactly how you read the market on the higher time frames. As we can see, this is all on the 4-hour time frame. And this is what allows me to develop my bias. For instance, we can see that in this case, we're in an uptrend. We can see that in this case, we're counter trend shorts because we're looking to come into a discount, looking to take out internal liquidity, looking to fill in all of these imbalances. And then what happens? Well, we're then looking for buys up to these external highs. It's as simple as that. Now, let's go through more examples. So with this example was perfect because we can literally see that we get the model that I just demonstrated to you guys again within an external model. Now, let me explain what that means. So obviously I just demonstrated how we come up, we come down, and then we look to target this external high again, right? Well, as we can see, we make this movement up, but we don't quite manage to make it all the way up to this high. So what does the market do? It does the exact same cycle again, right? We have these lows, we have these highs. What does the market want to do? It wants to come down and take out internal liquidity. Where's our internal liquidity? We have a low right here, we have a low right here, and we have a low right here as well. The market doesn't come into that, but pay attention. Why does the market not come into there? Well, let's mark out our equilibrium of the 4-hour range. And we can literally see that it is perfection. Price comes down, comes up, comes down, takes out this internal liquidity, taps into the discounted area by a wick, and bang, straight up to the external high. And then we take out this external high up here as well. Now you're thinking, well, where's the imbalance? Where's the fair value gap? Well, we have this beautiful fair value gap right here. And as you can see, the market comes towards that area perfectly, rejects off that area with this massive wick, and then bang, bullish, 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 buys, 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 buys. You see, that's how to read the market like a book. And look, this is the model presenting itself within an external model. Because obviously the external model is this. This is the low, this is the high, this is the rebalance, and then this is the movement up to the external high. But within that, we have the model form again. And this is going to keep happening over and over and over again. You just have to be able to identify it correctly. So let's go through some more examples to get you really, really comfortable with this, because this is going to allow you to literally read the market like a book. Okay, so now we've made it up to this external high. And as you can see, we get a continuation and the market is just charging higher and higher and higher. So what do? Well, we form a new external low and we form a new external high. Now, what does the market want to do? Well, because we're in an uptrend, the market wants to get a continuation. Do the big banks and institutions want to buy up here? Of course not. They want to wait for price to do the 3 things that I've told you about. So what's step 1? Liquidity. Price has to come down and take out internal lows. We have internal low here. We have internal low here. As you can see, the market comes down and we're taking out these draws on liquidity. We're gathering those resting orders, those pools of money. Now, what's the next step? Well, price has to fill in or rebalance itself out. So as you can see, we have all of these imbalances. We have imbalance here. We have imbalance there. We have an imbalance right below right here. But what does the market do? Quite simply, it takes out liquidity, fills in this gap, and then rejects. Now, what's the third and final step? The discount, right? Equilibrium. So if we mark out equilibrium from the lows to the highs, oh my gosh, pinpoint perfection. This is why I read the markets every single day. We can see we make a move from the lows to the highs. Price comes down. We literally tap into this equilibrium level, into this 0.5 region. We tap into the discount and bang, we get this bullish rejection candle. And then we get this strong continuation straight back up to the external high. Do you see how this is all playing out? How this allows me to read the market like a book every single day. And it's because this happens all of the time. You just have to be able to identify it and be able to make the most of it. Now, how would I act of this in this case? Well, when the market is extending like this, I'm simply looking for buys, right? The trend is your friend. Look for buys. Look at all these bullish candles. This is buy, 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 buy. Now, when we get to around this area, I may start to think, well, do the big banks really want to buy at this point? Do the institutions want to be putting in their millions and millions and millions? No, not really. So what's most likely going to happen? Well, what is most likely going to happen is price is going to do those three things. It's going to take out liquidity, it's going to rebalance itself out, and it's going to come into a discount, right? Now, once price does that, well, once I'm waiting for price to do it, once I start to get my confluences and start to see that, okay, price is going to make that reversal, well, I'm looking for counter trend sells, right? Obviously, I'm aware that the higher time frame bias is bullish, but I can look for counter trend sells into this level. Now, what happens once we get to this level? Well, simple. I then look for buys, right? Once we get our bullish confluences, once the market starts to tell me, Seb, we've done everything that we've needed to do. We've taken out liquidity. We've rebalanced price action. We've come into a discount. The big banks have already put in their millions. Well, now I'm looking for buys. And guess what I'm doing? Buy, 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 targeting this external high. And this is just a rinse and repeat cycle. Because we're in an uptrend, I'm going to rinse this continuously until we then flip. And then maybe we get a downtrend. And then I just do the same thing for a downtrend. Or if we consolidate, then okay, I just remain patient. I just wait for us to trend again. It's that simple, right? Now let's look for another example. I mean, this couldn't get any easier. We have another external low right here, literally within the same model. This is within the same model. We have this external low, right? We have this external low. By the way, this low right here is the equilibrium level, which we literally rejected off of. We have this external low and we have this external high. Now, what does price have to do? Price is coming up higher, 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 higher. We start to see signs of weakness. And then what does the market do? It rejects, right? It comes down because it needs to do the following things. It needs to take out internal liquidity. So we have low, low, low. All of these lows that we form, market comes down. As we can see, taken out all of these lows. What else do we want to do? Well, we want to rebalance the market. So if we see we have a bullish fair value gap right here, market comes down into this fair value gap. And then what's the final step? That's right, equilibrium. If we mark out equilibrium of the 4-hour range, we can literally see price comes up, comes down into this discounted area. We get a strong bullish reaction and bang, straight up to these external highs. And it's buy, 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 buy. Rinse and repeat cycle. So this is how to understand and read the markets on the higher time frames. And this allows me to get my bias right pretty much 99% of the times, because as you can see, and I'm pretty sure you're seeing it through watching this video, this is literally what the market does. Now, obviously, I've just shown you all of these models forming within this uptrend. Now, this is all an external model. Like this is all, sorry, that is all internal within an external model. It's the exact same thing. So we have this low down here, right? We have this low down here and we have this high up here. Now, what does the market want to do? Well, simple. Market wants to come up, come down, do the exact same things that I said it wanted to do, come into equilibrium. Perfect. As we can see, comes into equilibrium and rejects. What else does it want to do? It wants to take out internal liquidity, 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 liquidity. It wants to fill in imbalances. So if we look over to the left-hand side, do we have any imbalances that the market fills out? Yes, we do. We have all of these gaps here. We have this fair value gap right here. I have literally perfection. We can see that the market comes into this 4-hour fair value gap. Bang, we get this rejection because it aligns with equilibrium, and then it simply buys, 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 buys up to this external high. Now you see how I've literally just broken it down right there. We've just gone through many examples of that model that I've just shown you occur within this whole uptrend, but this is all within an external model, and this is the only way that the market moves. And once you understand this, and once you're able to apply this, it becomes really, really simple to read the market. So hopefully this video made sense to you guys. Hopefully you're now able to read the market like an absolute book. This is how to read it on the NADAQ and the S&P 500, which is what I personally like to trade. And yeah, Go have a look for yourselves. You will notice that the market literally does this all of the time. Same thing right here. I know I'm just going again and again and again, but what do we have? External low. What do we have? External high. What does the market do up here? Start to show sign of weakness. What do we then do? We then retrace into a discount. What else do we do? We retrace into this bullish fair value gap. What else do? We take out all of this internal liquidity that is generated on this movement up. And then guess what? Bang. Buys, 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 back up to the external high. And that is how you read the market like a book. That is it for today. Hopefully you enjoyed today's video on how to read the markets very easily every single day. Please make sure to like, comment, and subscribe. We're going to blow up this channel and I'm going to keep posting sick content for you guys. But I appreciate you all. I'll catch you in the next one. Peace.